Welcome to In the Balance, the podcast to help you build your dream team of experts to make your financial goals a reality.
G'day, how you going? Phil Tarrant, co-host of In the Balance. We're back. Second episode in. To much fanfare, launched last month, and some people saying that Manzrul Khan is the Kim Kardashian of the internet. He broke it. He broke all the records with accounting podcasts. Maybe one of the first. I don't know. Maybe it's the first podcast in Australia which really looks at accounting through the lens, or property investment through the lens of accounting, or vice versa, depending on how you're wired. But this podcast just isn't about property. It's about how you go about creating wealth as an Australian in this great country we all live in, and how you can go about using what's available to you to create the retirement. And that's pretty much what it's about, that some of us want and look for. I don't think Manzrul's ever going to retire. That's the mail I'm hearing. He'll probably work to the day he drops dead in some capacity, because he's made his life so complicated that he's going to have to work forever. Manzrul, how you going?
Very good. Thank you very much for having us.
It's good to see you, mate. Great feedback, really good feedback on the podcast. I'm getting, and I'm hearing that you're getting the same across all your partners and your client base. It's KHI Partners. There's a lot more than Manzrul Khan. There's a lot of partners in there, isn't there?
No, absolutely. Absolutely. We've got 24 partners.
Okay.
And I'm just one out of those 24
Just
partners.
one. He's only just a struggling partner chairman of KHI Partners. And we'll have a chat about the charity work that you do one day, sort of probably outside the scope of this podcast, but I know it's very important to you. You sit as a chairman on at least one charity organisation I know, and that's very much sort of based on your philosophy towards not only doing what you do in a professional sense, but paying it back where you can, and it's sort of quite broad-reaching, your philanthropic stuff. And we're going to have a chat about that at a point in time, but we are still only young and new in the Balance, only 2 episodes in, and just to reiterate very quickly why we're doing this. I'm big on why, and no doubt if you have a good accountant, they'll pretty much ask you why all the time, why you're making certain decisions, and help you shape those decision makings. And from what I understand and what I see, the best accountants will help you assess both sides of the ledger, understand the balance sheet, understand your assets and your liabilities, and in the balance help you make the right decision. That's very much connected with this podcast, and why we've embarked on this pathway to try and get the intersection between health and happiness and financial sophistication and choices for later on in life as everyone goes about building their wealth. We speak, and no doubt tuning into a lot of SME business owners who are using the old adage of making their money in business and parking in property, but there's also a lot of people who are PAYG employees who are generating good dough and looking to deploy that most effectively so they can create the best retirement for themselves, wealth creation. And I know the team over at KHI Partners, it's all about contributing to your life. Is that pretty much a guiding philosophy, Manzrul?
Yeah, it is. It is. And I feel I say that with a lot of personal passion and quite a bit of personal, I suppose, emotion as well, that in day one when we started our practice, we started with that one concept, which is contributing to your life. And every day, all of us, as all the individual partners, we try to understand and re-understand what that means. It's got so many different elements to it, right? So you've got that element where you are contributing to the clients, but it also has an equal element to us, for us to stay accountable on an ongoing basis, because that contribution is a lifelong contribution, right? So because we've seen it over the years that people go through, we've got a bit of success, and with the success that comes in quite a bit in our mind, that contributing to our life is to keep us accountable, saying that that success is that it's a short term, unless and until we stay consistent, we stay persistent, and we stay that very long-term vision with the clients.
So what I see and have seen working with and knowing a lot of very successful people, whether it's successful through life or sport or finance or investing or whatever, success leaves a lot of clues. And what you're talking about there, contributing to life, is a bit of a guiding philosophy for helping you sort of shape decision-making. But that's only one part of the equation. What I've seen the best do is that they have a really comfortable understanding and can move between concepts very quickly to get the outcome that they want. And the only way you're really going to be successful as a property investor or investor in general, or SME business owner in general, is to know where you're going. You need to have an objective. It's absolutely critical. You need to know how you're going to get there. That's the strategies you use to get there. That shapes it. Then you need the right tactics to maneuver through those things. And often a lot of the ways you go about doing that, depending any sort of sense you want to view this in, you typically have a doctrine. That's how you do stuff.
Yeah.
And everyone does it slightly different. But this particular podcast, I think we're going to have to jump around be between the intersections of philosophy and all the why and warm stuff, which is nice and it shouldn't be discounted. But I really want to use the opportunity to catch up with you and your partners to get really strategic and tactical level. And already one of the pieces of feedback we had from our first podcast was really, really good, great idea, great process going through this, talking about it, but let's get stuck into the actual real strategic and tactical stuff that only a high functioning and capable accounting practice would be able to do. I think we're very fortunate in Australia. We have a really large cohort of accounting practices. Some of them are very good at just doing mum and dad tax returns, which probably isn't your client base. You probably have more sophisticated clients who need to get into the nuts and bolts of getting stuff done. And you've brought two people into the studio today to help us with some of these things, to get stuck into tax and structures and everything interconnected with it, both within property but also other asset classes. Boho, Haroon.
Thanks for having me over, Bill.
How you going, mate? Senior partner, KHI, and
Yes,
Stephanie Youngman, partner at KHI. Both of you, who I work with at a tactical level, I guess you can call it, using that construct we spoke about, but you also support strategically, and we'll use that as a bit of a scaffold to help steer the conversation today around strategy and tactics. And if you don't understand what these things are, you probably want to get familiar with them pretty quickly, because it's going to shape your decision making. So you need to have an objective. You need to know where you're going. Your strategy is going to tell you how to do it, and then the tactical stuff is really the stuff that happens on a day-to-day basis to get you there. But I didn't know this about her. I was at a function, and you come up to me and said, "We've never met before, but I know who you are because you do my self-managed super fund."
That's right.
Compliance and trust. And I remember it because I remember apologising profusely straight away, going, "I'm so sorry. You guys have been chasing me for ages." And I think my fund maybe was probably in a border zone of maybe not being compliant because I hadn't done one or two things.
You did get to me next day.
I did get it to you. Yeah. I got the hurry up. Certainly got the hurry up. But yeah, so you look after my self-managed super fund stuff, which is cool. And I'm happy to sort of challenge in principle around those sort of things. And Stephanie, who works really closely with Munzrule, and people are going to be going, "Oh, this is just Phil's gang of accountants," right? But just give you a sense, though, like the breadth of advice and advisors that you would have if you're a serious property investor or you've got a more sophisticated setup. It's wide and varied. And Stephanie, who works very closely with Munzrule, works with me on a lot of the tactical level stuff and compliance stuff for me. So very much augmenting Munzrule's skills and capabilities. Munzrule's a man who's pushed for time. So Stephanie does most of the work these days, Munzrule. I'm sorry. Sorry to put. So that's to give some context. To give some context to our listeners about, the type of advisors you may have in and around property or investment, depending on what you're doing. But is that pretty common, Munzrule, for people to have sort of multiple touch points with different advisors in your firm?
I mean, when we started the practice 16 years ago, right, we started that practice saying that every single client will give absolutely the amount of the time that needed in terms of contributing on an ongoing basis.
Yeah.
Now, that worked very well for a period of time, right? And then time has started to become a bit of struggle, and then you delegate, you create more time. And then one day you sort of look back and you say that, that service is almost becoming a disservice. And the reason why the service is becoming a disservice is that rather than having a one-man brand, is that it needs to be a collective level of effort, right? So whereas Steph and Aboho and I, as well as all the rest of the accounting partners, we work very, very well together, is that let's say if there is an entry level of clients, many of those clients, they would get much better service from Steph in terms of the time, in terms of just that hand-holding in terms of what they do. And some of the sophisticated clients, as an example, that perhaps I do the strategy session. But the beginning clients, if they go to a Steph, it doesn't mean that it only stays with the Steph. We are in the same office in the Parramatta, right? And a Steph's client is my client is a Steph client. So Steph very often brings me in in part of some of those strategy session. So where it works as a win-win from a client's perspective is that they get that sort of a hand-holding level of service from a staff. But when the strategies is being needed, I sort of come in. Abajo is an example that with the self-managed super fund, Abajo have got a very deep knowledge on the self-managed super fund. We've got a specialized self-managed super fund division who sort of just does the self-managed super fund the way it needs to be done with all compliant heavy, right? Very specialized. So again, if Abajo needs the strategies, I sort of come in as a strategist. As a team, it's really working well.
Yeah, it works well, and it's important because it was Stephanie, and we peaks and troughs when we work. It's normally sort of super condensed, and then it'll be sort of bit light for a while and be super condensed again. And that's just the cadence of tax time and tax returns and different things that's going on. I'm not that hard to work with, am I?
No, absolutely not. Firstly, thanks for having me, Phil.
No, it's your first podcast, is it?
It is.
God,
it
are you
is.
nervous? You should be. I'd be worried. You're sitting here with Mundiral. Mundiral's a tough taskmaster. I'd be packing it if I was you.
Oh, they got a staff.
No, it's good. But this is why I wanted to make the point around strategy and tactical stuff. And a lot of people, and I see it all the time, particularly with property investors, they get so obsessed with, the grand vision. I'm going to retire with this much money and whatever, right? Like, and whatever the choice is, whatever that looks like for you. And you could have the best strategy in the world, but strategy is only as good as how well you execute on it. And that's where most people are wanting. And that's where I would score me probably not effectively a lot of the times, is that you have the right intent and the right effort to create a strategy, but you just don't really get stuck in and implement effectively. That's why you need someone like yourself who can do the doing. The important stuff is the day-to-day stuff largely.
That's it. And we do try to, push clients along and touch base and, whether it be annually, quarterly, to make sure that they are, sort of on track in achieving their goals. We've got some people who we meet with and they want to go out, buy every property, and things just don't work that fast sometimes, unfortunately. And then there's that, the other people that come to us and, they've got so much potential to, purchase so many properties straight away, and they may be a little bit more hesitant to just, dive straight into the deep end. So we've got to, work out a happy medium and nice pathway forward.
And a nice pathway is good. It's got to be an individualised pathway as well. Not everyone's
Absolutely.
the same. And no doubt Mundiral probably makes a requirement for all his partners to be property investors, which is good, right? It's good to understand it from the ground up and noting that, I think pretty much everyone here in the room, except for maybe Boho, doesn't agree that property is the best asset class there possibly is. And we'll touch that at some point. We'll touch that at some point. But you're a property investor?
I absolutely am, Phil.
Yeah.
I've been investing in property for nearly 7 years now.
Okay.
So I've now got 6 properties, my husband and I, split between our individual names and now our SMSF as well as of this year.
So you're still pretty young. I won't ask how old you are, but that's a lot of properties for someone to say young.
Yes.
So did that happen by accident, or was it the steady guiding hand of Mundiral Khan, a good accountant, sort of making sure you're going in the right direction?
It didn't happen by accident. It was an intentional sort of decision. At the start, it was a little bit challenging. I sort of jumped in without too much guidance, and I didn't buy my first property very well at all.
Okay, standard story.
Yeah.
Well, normally that's I think 70% of all property investors only have one property, so it mustn't have been that bad a property because you're able to bounce back.
I think that's what that first investment not being the best investment is what sort of encouraged me to, I guess, seek out more information and seek out more mentors, more resources to understand how people do it successfully, and then implement that from there.
Okay, so property is, I'm not going to say has been good for you because it's still in the process. It's an asset class you like, you enjoy, and you'll do more of it, do you think?
Yeah, absolutely.
Yeah.
Absolutely.
So what's the grand plan? Because I want to talk, like as I mentioned before, about tax structures and stuff, but
It's a bit difficult to sort of say where the end goal post is because, I think like Manzirul, some of us don't ever see ourselves getting out of the accumulation stage.
Wow.
You just sit there behind and just go, what?
To clarify, she's just basically making a comment on how old we are.
Steph is such a good example because I've seen the growth on Steph over the last 4 or 5 years that you've been with us, right? Because when you joined, you had those couple of properties. And if I look back to Steph and if I sort of say what are the attributes in terms of your success, is that number one, you've taken the action, yeah? So one argues that any action is perhaps better than no action. And number two is that you've learned along the way, right? So all those sort of the clients who are sort of having into trust, having multiple properties, learning along the way. Number three is that you utilize that in-house resources. So Frank Wong, as an example, who'll be coming in, he's in our finance. And Frank has a significant contribution in terms of your wealth creation because Frank came in with some of those funding opportunities, right? And then even in terms of that self-managed superannuation fund. So I look into Steph and I sort of say some of the other people that I see at times is that even if you give that right level of opportunity with all the gradients, it still comes back with the action taking. And that's
it's all about action. It's all about that. So I, where I'm not a good investor is, again, I have all the best laid plans, but I get caught up doing other stuff and I just don't get around to it. I imagine you're probably a little bit more disciplined than I am. You actually get done what you need to get done. I'd hate to see your personal compliance. I reckon it's probably
you tell me
good.
about a taskmaster when I have to sign an accountant's letter. She sends it to me at 3 o'clock. 4 o'clock, you're following through.
Yeah,
Manzirul Levy signed it.
It's good to be organised, but it's a huge advantage, right? Like you get a huge advantage just by being focused.
Yeah, Phil, I've been an accountant for more than 10 years, so I feel like I've actually had the benefit of having the knowledge well in advance of needing to use it.
Yeah.
And I must just say I've been bursting at the seams and busting to be able to use all of this knowledge that I have for my own personal wealth creation. So if that's a real personal driver and incentive to keep going for me.
How often would you think about that every day? Like, how often do you connect the idea of me doing this job? And all jobs have good bits of it and all jobs have bad bits of it. And you want to make sure that in the balance, it's a good job, right? But how often would you directly connect what I'm doing with work with how I can continue to create wealth in property? Is it like an absolute guiding principle?
It's all the time. I think there's a lot we can learn from clients, whether, there's clients that are slightly ahead of you in their wealth creation journey and what they've done well, the properties they've bought well, what principles that they've used to sort of guide them through their success, and also the clients that aren't doing, have made mistakes along the way. What mistakes have they made and how can I learn from them so that I'm not making the same mistakes?
So essentially you get an education course every day just talking to clients to see how they've done stuff.
Absolutely. And completing their compliance work as well.
Such a huge advantage.
Yeah, absolutely.
And a lot of people go through life with blinkers on. A lot of accountants probably go through life with blinkers on and probably don't have that sort of connected regime of complementing the education that you're getting on a daily, if not hourly basis with action. Do you find yourself comparing yourself a lot with your clients?
Tough question.
But you know what I mean. Do you ever sort of sit there and just go a little bit of professional jealousy, or you know what I mean? Like, man, it's good to be aspirational, but do you sit there and just go, oh, this person's a bit ahead of me? They're a bit sort of similar. What,
Comparison's the thief of joy. I'll start with that. And also that everyone starts in a different place. So, there's some people that are coming in very young and have had a lot of help from either, their parents, inheritance, things like that. They're already at a starting point. Some clients who are very successful and we're now helping their kids along the way. Well, they're already a step ahead because they've got their parents guiding them and putting them in touch with the right people at the time, that they need. So everyone, goes through a different walk of life. Some people are starting ahead and starting early and there's people in their, mid-30s and 40s who are only, starting to think then about their wealth creation journey. So everyone's very, very different, and
Very, very wise and measured. Like, I'm really impressed, Stephanie. It's I would have gone, I see them all the time, and I, want to run around putting a banana in their exhaust pipe to try and stop them out there sort of buying property. But it's very, very measured and considered, and I think that's what you really want from your accountant, to be honest with you. But but do you, on the other side of things, do you sort of do you see investors or maybe wealthy people in a situation where you go, I just wouldn't want that headache, like where just go all these properties and all these bills and all this compliance and all this, like, is too big sometimes too big, do you think? Have you sort of had that, have you looked at it and go, oh, that's...
I don't think so. I think it's a small price to pay for, the benefits that it brings.
Okay.
So.
Well, there you go.
And ultimately, it's my problem, not the client's,
Yeah.
client's problem. So,
I suppose sometimes it's the system and the automation, right? And
Yeah.
it's sort of also the process and the and the process, yeah.
Yeah, it's intriguing. I often think, because I complain a lot about property, because I've got a platform to complain about property, and Munzrel and Stephanie, you have and Boho on through a different structure have the unfortunate privilege of having to help me navigate this sort of stuff. And I must admit, on the SMSF front, I probably should be doing more for some stupid reason. Maybe you'll agree with this. I think maybe we spoke about this once. I'm diversified inside of my self-managed super fund because I feel like I shouldn't just be all in on property. I was actually chatting with someone the other day who most people would know who they were, and they went, oh yeah, I sort of mess around with stocks and shares, but I'm a property person through and through. I know property. I like property. I can get the right outcomes in property. I see my self-managed super fund. I still invest in shares because I feel like I need to be diversified, right? I wish I didn't. Maybe that's maybe I wish I should be all in on property. But do you see people working specifically within self-managed super funds a reluctance to diversify? It's quite a sort of broad sort of question, but you're beaten into you that you should be not putting all your eggs in one basket.
Complicated question.
Yeah, it is.
I'll
No,
take it apart
it
a
is
little
very,
bit,
very
right?
complicated.
So it all depends on, again, and I know it's a tried and true approach. It seems somewhat like we're repeating the same point, but it really comes down to who the individual is, right? And what they're comfortable with. Now, when it comes to a self-managed super fund, as the name suggests, the investments are self-managed, right? So it all depends on what they're comfortable with. There's merits to both. Being all in on property, being a little bit in shares. Liquidity is an important event as you get older. So it's really important to know who the client is. Now, of course, I'm not a financial planner. I can't give that bit of advice. But if I give you any advice or an example of sorts, if you have someone who's, suppose later on in their years past 65, they've got all of their assets in property, they're going to have a tough time paying their minimum pension, right? So there's nothing wrong with being diversified. In fact, it's almost preferred. It's just, where does your circle of competence lie? So if it's property, go for it. If it's a little bit of shares, so on and so forth, go for that as well. Maybe we take a measured approach of both of them. So there is no right way and wrong way, I suppose, unless you lose your entire balance for some reason.
Yeah, So what did you say? What's something confidence? What was the term?
Circle of competence.
Circle of competence.
Yeah.
Okay, I've never heard that before, but that makes a lot of sense.
Yeah.
So you should stay within areas that you really know. Some of the worst investment decisions you see people make is where they don't understand the asset class they're investing in.
Or you bring advisors on board who are better at those particular. For example, Stephen James from our end is really well. He does really well with shares.
I think about that's the point, right? That's one of the point, that it doesn't need to be a compliance exercise on the super fund. It should be much more than a compliance exercise, right? And much more means that, yes, every year when we do the set of accounts and the returns, we do the set of accounts. That's what we need to do. But we sit down and look through some of the analytics, right? We look through the analytics, number one, in terms of your investment property, how much was it as a positive or negative cash flow, right? And what's the tax ramification behind it, and what are the other returns that the clients receive? So we give all of this factual information to the trustee for the trustee to make a decision saying that, yes, that's where we started, but whether we change that along the way.
That's right. That's right. Absolutely.
So what's your ideal client look like?
Oh.
Well, because relationships swing both ways.
Yeah.
And I've been saying this for years, and if anyone ever asks me for advice, I tell them I can't give advice because I personally don't know what I'm doing. I'm surrounding myself with really, really good advisors. But one sort of tip I give people is that you've got to be a good client. So you've got to be it's like being coachable. You know, they say some of the best sports people are coachable, right? Yeah. I would say some of the best investors, they're largely coachable by their advisors. You know, they put a lot of inputs in. You still got to do the hard work yourself. Some people I see have quite a fractious relationship with their advisors. They don't treat them well. They're quite needy as clients. They're quite demanding. They might not pay their bills on time all the time. But to actually get the best out of your advisors, you've got to be a good person to work with. It's got to be some sort of connection, right? You know, so the best sort of clients for you, I guess, have got to be considerate of the advice that you're providing them at the start.
Yes and no. And the way that we approach, and I've learned this from Manzurul, to be honest, is there is no such thing as a bad client, right? Yes, you know, at a certain stage, you want to be receptive of the advice that I'm giving you. But on the other side, I also have to, as an advisor, put myself in that person's shoes and understand where he's coming from or where she's coming from, and understand what is the path that they want to choose for themselves. My role as an advisor is not to guide them one way or the other. It's here's the information to show them this is one path you can choose and these are potentially the results, or there's the other path and they have to decide. We don't, as far as I know, we don't really hammer on them that, no, this is the right way to go. We give them options and let them choose their own path as such. So to answer your question in a very long-winded way, who's an ideal client? Anyone we can help.
Anyone you can help. Yeah. Which is quite a nice philosophy to have.
I mean, it's worked so far.
Yeah. Have you ever said to a client before, we don't want to work with you anymore, Manzurul?
Look, I mean, there's some rare exception we draw a line, right? And have we drawn some line? We did. And where we sort of say everything goes except just that one line, and the line of righteousness. And we sort of say that anything which we do out of the straight line, anything which is a little bit silly, a little bit wrong, a little bit out of the law, not for us, right? So where there's some circumstances in the past we had to say no, we did. More of a rare. Very often Australia, as we call, is a lucky country, right? You speak to people and people listen to you and it gets adopted and changes. Yeah. And I think a fundamental thing with the client certificate that I always ask the question that as long as it is a fair go on both ends, right? As long as it is a partnership along the way, and as long as we look into a very long-term relationship, right? That's right. Yeah. And this is where there's no sort of an advantage taking, then it works over time.
It is a long-term relationship with your accountant. And I see people shopping around accountants all the time, and I just go, you just haven't found the right accountant yet. But I would caution not to do it too often because you need to invest quite a lot of time, energy and effort into a really good relationship with an accountant, particularly if you have a more sort of sophisticated construct. But, you know, it's quite a personal relationship with your accountant. They pretty much know everything about they should do the job well about your financial sort of positioning. So, you know, shopping around accountants based on fees and stuff, I think is absolute madness. And much like a sophisticated property investor, in the hierarchy of importance, the interest rate is often quite low down. And I imagine the same thing applies with fees with a very, very good accountant. You've got to enjoy getting together with your accountant. If you don't, you're probably with the wrong account. I enjoy catching up with my accountants. I always feel energized. Sometimes a bit browbeaten, depending if I've been a good boy or not with Manzurul. But I always enjoy it, and it should be something for most people if they're focused on wealth creation to actually look forward to meeting with your accountant. But you said something, Manzurul, there, and it sort of echoed with some notes I've got here, which you provided me. You said we go deep in tax planning, however, never in tax avoidance.
Yes.
That is a critical path that all accountant needs to tread, and you have professional responsibilities and obligation towards that.
Absolutely.
Can you give us some colour to that?
Yeah, no, absolutely. I mean, the tax planning is legal and it's being encouraged, but absolutely not tax avoidance, right? So you do the tax planning, you do the tax minimization, but you do the tax planning and the minimization within the rule. So a fundamental golden rule that we have within our practice is that every single return that we do the return with an assumption that it would get audited, right? And we ask this question that, is this return done as an audit proof? So we've got a whole bunch of things. We've got a data matching, we've got a benchmarking, we've got a, the various level of intellectual information that we cross-check and we sort of match it whether it's right. And very often we go back to the client saying that, well, you are a builder, and based on the statistics on the building side of it is that this is what the ATO is suggesting as your revenue should be, your GP should be, and your net profit should be, right? And if it is quite a bit out, then we ask the question, why is it out, right? So tax avoidance, absolutely no. And Australia, as being a self-assessment system, means that anyone can be reviewed and audited at any point of time. And the tax ramification, cost ramification of that is significant, yeah.
Yeah, it can be, and I think that's well considered. Mun's rules, it's probably a good pathway to be on. But about your investment banker background,
Yeah, that's where I started.
How did you end up
in tax?
in tax? So would you say you're in tax? Are you in tax? Are you? You're
Tax
a
and business advisory,
tax and business advisory.
Yeah.
Yeah,
That's,
it's probably a very similar thing, right? Investment banking. So,
Yeah. Look, I mean, as I suppose in tax and business advisory, I think it's almost on us to be quite well across several kind of
So you do
aspects of
more
it.
than just my self-managed super fund. No, I
Yes.
thought that's all you did.
No, I do it to quite a few corporates as well,
Yeah, okay.
and individuals as well, as it is. But yeah, no, I started off my career in equity research. I moved on to corporate banking, moved on to raising debt and equity capital. I had insolvency there at some stage.
Yeah.
And now I'm a tax accountant. But I think that's each and every single one of those aspects have really lent me to kind of see a person and see what exactly he needs and guide him towards the expert.
So what gets you up in the morning? So when you sit there and just go more tax accounting, like-
Right now, my 19-month-old.
Yes,
That's what makes
it
me
helps,
up in
right?
the look,
Lovely.
I mean, and not to put too fine a point on it, I think the philosophy from Manzurul has really kind of permeated the organization. At every point in time, are we overthinking things about clients, so on and so forth? Maybe perhaps we're guilty of that. But really solving what seems to be on a client's end, it might be a really critical problem. Perhaps from our standpoint, because we've gone through it so many times, it's not as critical. But to have I'm going to use the word humanity, to be like, okay, no, he's stressed about this for a certain thing. That kind of helps me out to have those human conversations. Be like, okay, this is how we approach it. This is potentially how I will support you. These are the experts that will support you in this process, and not so much hand-holding, but guiding people along that process, having those human conversations, helping them along. It all comes back to who we are as adding value. And like you said earlier, the more you add value to people around you, you grow yourself. So that's
So how do you measure a job well done? How do you sort of sit at the end of the day and look at a sort of 360-degree feedback and say, today was a good day? What I do for a living is a lot more tangible. It's probably a little bit more sort of metrics driven. But how do you say, I've done well today?
there's a short-term view of that and there's a long-term view of that.
Yeah.
I think ideally what it is because we are with the clients for such a long period of time, it's kind of having them with us for that long period is in itself some sort of validation, so to speak, give or take.
Yeah.
But I'll give you an example. On a Saturday morning, I pick up a call at 7 a.m. because I know the client needs that bit of a call. And he's so thankful for me to pick up that call. And I'm just solving a very, very simple problem for him. But for him, it's the world. That's a job well done for me.
Very good.
It's pretty cool. Like, because you probably don't get thanked
Yeah.
No,
a lot, I imagine, as accountants.
No, people are grateful. People are very grateful. In my experience.
Yeah.
But no, I'm very blessed to have clients that appreciate what I do.
I think
Yeah.
one of the things, if I look back and reflect, right, it really worked out very well with our case is that we always try to give a fixed cost.
Yep.
Sometimes what the clients are quite conscious is that every time they pick up the phone, whether there is a charge, every time when they meet, whether there is a charge. What we say to the client is that we say it's a fair go, and it's a fair go from both ends. We give them a fixed cost right up front, and we try desperately stay within that sort of fixed cost. then what it does is that the client's sort of almost taking away that obligation
Yep.
that, well, I've got this slight question, can I call, can I not call?
That's right, yeah.
But over a period of time, it actually works out very well because you build that relationship.
That's
right.
And you build the client as well, and his success is your success over the
Yeah.
period of time. So I'm very grateful for the clients. we
Yeah,
have.
I don't know. Maybe I look through my particular lens. I've never questioned bills from advisors. You know, it doesn't even normally I would question most bills, but
Yeah.
when it comes to sort of financial advice, I never query it for some reason. It's quite funny. I guess that comes down to the inherent trust you need to have
Sure.
with someone who you're relying on. For significant decision making. And you think back to the COVID periods, they said that accountants were the doctors and nurses of Australian business, right? Like you're probably at the intersection of most significant choices that most people make in life. You know, it's someone's having a baby. I need to speak to my accountant. I want to invest in this. I need to speak to my accountant. I'm having a relationship breakdown. I need to speak to my accountant. You're the first.
I
port
cannot
of
tell you
call,
how many
right?
times clients have actually picked up the call and told me about their first child before they've told anyone else.
Really?
This is no
Yeah,
joke.
God.
This is no joke. I'll show you the messages
Yeah.
later.
Well, get him on there. Onto the
well,
family trust straight away. They're just born, but how much can I put in my super?
It's even to just share the news. So
Yeah.
that gives you an example of the trust that we enjoy, and I'll say it with a lot of
Yeah.
pride, is we enjoy this trust from our clients where, you know, they haven't told perhaps even their father, mother, sister, brother, but it's
Yeah.
like, oh yeah, so
It's funny
Is
with
my
accountants.
finances
Yeah,
okay?
it's funny with accountants. It is, again, a bit of a dichotomy with the fact of bringing accountants out of the shadows with a podcast like this. Like most property podcasts are sort of flamboyant real estate agents or buyers agents or people with big personalities and dare say ego and you could probably throw me into that as well. Like, but accountants are normally the quiet, trusted hand that, and it's to the point they're probably hugely appreciated, but I just don't really see accountants getting thanked a lot but when you say that, it's the first point of call. I don't know. Do people thanking you, Stephanie? People say, thanks, that's a good job, well done. Yeah.
Actually, do
sometimes.
get that quite a bit.
Really?
Yeah, it's very
There you
nice.
go. Well, maybe.
I think we actually blessed, right?
Yeah.
Because
We
I
are.
think we all do, right? I mean, if you look back to many of your clients, they become your friends over a period of time, right?
Yeah.
And some of them become really, really good friends over a period of time, right? So, yeah, no, I think we're blessed. yeah.
So what bit of your job do you like the most, Stephanie? Is it sitting there working out structures that people should be in? Should I invest in a trust or out of a trust? Should I set up a self-managed super fund? Should I do this? Should I that? Like, which bits are the best bits for you?
I really like helping people. So, to be able to solve a difficult problem or to be able to give the client a better outcome than they expected is, it feels really good for me. That's what I really, really enjoy. And overall, Phil, I'm a logic person. I'm a numbers person. So even though the client doesn't see me, maybe solving a difficult numbers problem for them, I definitely get enjoyment out of that.
So do you enjoy the numbers, doing the numbers, or you enjoy the outcome? Or you like the
Bit of both.
process, right?
Bit of
You
both.
like the process to get the result. You like the outcome. So,
I'm an outcome-driven person, right?
Yeah.
At the end of the day, I can build up models until the cows come home. But
Yeah.
at the end of the day, it's what value have I added to the what's the tangible value, like you said?
Yeah.
Tangible value to the client. That's where I kind of probably sort of tick or cross.
and I think
however.
KHI is probably fortunate with having someone like yourself in there in a senior capacity because they're all sort of bleeding heart, flag waving property investors, right? So I reckon you might get a bit of a counter argument from you sometimes.
To be fair, I
Yeah.
have entered and exited the property market with a profit, so
Yes,
I
yes,
should.
yes.
I'm kind of tooting my own horn.
I'd like to see your and Munzrel's conversations behind closed doors.
Look, the way that I look at investments in general is a little bit of scorekeeping of sorts. I try to not get emotional about things. I try to use my own investment thesis of sorts. That's probably
What's
I think-
your own investment thesis?
no investment advice given.
No investment. There's no advice at all on this podcast. And everyone, including our friends at the regulatory bodies, can
Yes.
listen to the disclaimer at the end
Yes.
of it. This is just a couple of people sitting around talking about
Yes.
investing in general.
Perfect. So
Yeah.
I'm quite a fan of Ray Dalio and the way that he looks at investing. he coined this term quite a number of years ago in the 1980s. It's called the all-weather portfolio. I think by and large that is as foolproof as you can get to building wealth over time. Over time being the underlying factor over here, and that simply says if you have equities, that should potentially be anywhere between 30 to 40% range.
Okay.
If you have debt, that's roughly in the 70% range for debt instruments, so to speak. Right? And the reason why is the cost of equity is higher, the cost of debt is lower. If you can use the interest cost of the debt as a tax deduction, kind of gives you a little bit of an uplift on the returns, but also because it's a safe return, it kind of balances out the portfolio no matter where the economy goes. So that's my philosophy.
That's working well for you. What do you think about it, Munzrul?
This is where we debate. This is where we strongly debate. And where we strongly debate is that we say, of course, rate value is rate value, right? Yeah. And you look into rate value and you sort of say, well, and everything which Abha has said is right. But what we do within our organization is that we say that you stay unique in your own way. I stayed with the property investment on my own, right? So all my portfolio is 100% on the property investment. I don't have any shares. I don't have any managed funds.
Nothing else?
I've got no shares. I've got no managed funds. And so
what's he doing, man?
And one understands the diversification, right? Yeah. But then you sort of look through and you sort of say, well, all those things that we spoke, that can we get that within the property portfolio, right? Can I get diversification within the property portfolio? So we can get different geographical, we can get different level of properties, we can get buy and hold and buy, renovate and sell and construction and development projects. Right. There are lots of ways that we can get diversification, right? Residential, commercial property. Can I get liquidity within the property side of it? Well, if there is an equity being left within the property, is that whether that gives the liquidity, right? Whether your offset account, whether that gives the liquidity as such, right? Whether we can look through into the longer term, right? When you say, longer term in terms of the asset side of it is that if we look into the cycle, right now as an example is that we're speaking quite a bit. We say that, Melbourne seems to be cheap, right? Like you look into Sydney and you look into Brisbane and you look into Perth, you look into Adelaide and you look into Melbourne, even lower than that, right? But you never know which point of time that Melbourne would do very well. So if you've got a bit of investment into a whole bunch of different portfolios as such, whether that gives you a diversification. And then we speak about the compounding impact. The fact that the bank gives you up to 80% LVR, whether it goes to 90%, right, and you use that 20% or 10% as sort of a deposit as such, that's your first property, right? And ideally in the second and the third and the fourth property, you get this. So I look back into my portfolio and I say, you know what, that has really done well. So again, nothing about shares, managed funds. We've got financial planners who would be coming in as part of this podcast, right? Yeah. And they would be going a lot deeper into the shares and managed funds. And that's right for some people. And in our case, in my case, it's probably
you've got to trust. You've got to trust and back yourself. And when I was talking to you, Stephanie, about seeing some people's portfolio, when you sit there and go, "Oh, I wouldn't want anything to do with that." I was talking about Munzrul's, by the way. It sounds like a hunger. It sounds like and I don't think. I think I sort of have a sense for your portfolio. I know you don't really sort of go into too much details around it, but I don't know how you find the time to manage it, and it's a hungry beast, a large portfolio in terms of time to manage, where I would argue that maybe other asset classes are probably a little bit more forgiving in terms of time, right? And this would shape someone's investment decisions, right?
It's again, what works for you. It might not work for somebody else. It might work for what's worked for him wonderfully well. And of course, he spent countless hours researching, and I don't think it comes across how much well-read he is.
Yeah.
Well, maybe
most emails get from Munzrul like 1 and 2 in the morning. They're like, "I've seen this, you've seen that," and
he spends an
unfortunately sometimes I respond to them at the same time, which is well, it sounds like a very diverse. And I'm semi-familiar with the breadth of KHI, but you've got a really diverse partner base here. People from different backgrounds, professionally, different attitudes, different ages. That's pretty important. But what's the pecking order like in the office?
What's the
pecking order like? Who's sort of like?
You don't want me to answer this question.
What's it like?
I'll say it in a nice way.
I'll say it in a nice way.
Look, we all have a tremendous amount of respect for what Munzrul has done and what he does on a daily basis for us. We also have a tremendous amount of respect for him giving us the latitude to do and think how we do, and he gives us respect for it. So the pecking order is,
Pecking order is there is no pecking order.
No, there is. Munzerl says
That's a term,
and
it's an endearment
generally
term as well,
correct.
pecking order, right?
That's right. Whatever Munzerl says is generally correct.
Yeah, but we take a lot of feedback, right?
Yeah,
We
yeah.
actually go around and we take
That's
a lot
right.
of feedback, and we say that within our organisation as Steph, that it's sort of, there is no, like, we take a lot of pride of saying apologies and also thank you. A lot of pride of saying, I know you and I, we had a very strong debate. I apologise, you were right and I was wrong, and I've learned from it, right?
Is he wrong? Quite often.
Oh, I celebrate the times he is.
So do I. You know what? Every now and then, and sort of back to the point around, you know, being able to speak philosophically and outcomes orientated, but then really, really tactical. I often like asking Munzerl an accounting question that makes him think, and he go, and I could see him sitting there thinking, going, "How does this idiot know or think like?" To call myself an idiot. Yeah. Like, how does he know to even think that way around something like, you know, most, you know, I'm comfortable around accounting. I'm not an accountant, but accountants like to be challenged as well, right, by
We
their clients.
love
It's
it,
so
Phil.
important.
Absolutely, we love
Got to be
it.
curious.
Absolutely. We never ever say that we know all the answers. We don't, right? And more sort of the hard questions that we get that we don't know the answer, more we love it, right? I mean, how many times, Steph, you and I in the office, we debate on a particular way, right? And we go around and we learn. And very often we call each other, right? I mean, I would be calling Abaho and I would say, Abaho, this particular situation, what do we think, right? So that's number one, that we never ever say that we know everything. And the second thing which we also say is that we never ever say that everything which we do are always 100% right. We try to make it as right as we can, right? But along the way, when things goes wrong, you take the responsibility. Yeah.
So, sorry, Jordan, how far in are we, mate? I haven't got the clock on it.
Oh, sorry. 47 minutes.
Okay, cool. Thank you. Let's start again. So, sort of nearing the end of the podcast, let's talk about. And I think Munzerl, as we build this out, we're getting some sort of different themes and ways we can structure this. What's back end we can ask, and we'd really like some questions. All those questions that you wanted to ask your accountant, you didn't want to ask because they thought they were going to charge you. Don't worry about that. We've got them here free on speed dial now, so do not panic. Send your questions through, and we'll answer them on air. We'll make sure we get the right KHI partner in to maybe facilitate that, because they've all got different skill sets and capability. You can email hello@khipartners.com.au. So send your questions there. Anything you've ever wanted to know about accounting, whether it's through property or small business or business in general, or estate planning or anything connected in with it, send it there. You can also get in touch with the team there if you've got any queries or questions. And one of the reasons why one of the main reasons we launched this podcast is to engage all those existing customers and clients of KHI, which I didn't realise there were so many. So that's a nice conduit. So if you haven't connected in with your accountant for a little while out there, KHI people, hello@khipartners.com.au. But some stuff, I want to finish every podcast with some real sort of tactical level stuff. Some might say strategic. Stephanie, trust or no trust for a property investor?
It depends, Phil. It depends.
In the balance of things.
In the balance of things, we
Yeah.
would look at how many properties that you already have where they're currently invested.
Yep.
We may look at other things like land tax, and we'd look at the client's risk profile and tax planning as well.
Yeah, and again, a lot of people, if you listen to a lot of podcasts all about acquiring properties, where to find the best property, which one's under market value, which one's going to go up the most, that's all fine. You do that once when you purchase the property, then you've got to hold on to that property and manage it for hopefully decades, if that's your particular structure. A lot of people forget that there's a whole bunch of costs connected with holding property, land tax being one of them, and investing in a trust. I imagine a lot of people get a rude shock when they get their first land tax bills as property investors. I'm sure you've seen it before.
Yes.
Yeah.
They acquire one too many properties, and yes, land taxes, of course, state-based. So we try to, if we're looking at where to purchase, we may, look at what properties you already have in each state and compare them to the land tax thresholds to potentially to potentially have the client make a decision on where they'd like to purchase their next property.
Yeah.
And sometimes that may mean paying more land tax.
Yeah, and sometimes that's a price for doing business, depending on the structure you hold it in,
Absolutely.
for a whole bunch of reasons. Again, we could probably get into real specifics around it, but it raises a really good question, Munzrul. Who do you speak to first? Do you speak to your accountant first? Do you speak to your mortgage broker first? Or do you speak to a buyer's agent first, your buyer's agent? Or do you start looking for property first?
Yeah,
Who do you
good-
speak to first? Because according to Stephanie there, you probably want to make sure your accountant's pretty central in your
Yeah.
decision making.
Yeah, and I would dare suggest the accountant, and the only reason I would dare suggest the accountant is that this is where the idea sort of starts in many ways, right? But at the same time, I say that the accountants, with all the strategies and everything else, right, it sort of has no implementation without a good mortgage broker, right? Because we, as an accountant, we can come up that we can do this. But if the funding isn't there, then it doesn't happen. Then we go to the buyer's agency side of it, right? That we can have the mortgage, we can have all those strategies, but without finding that right property, it doesn't happen as well. So in an ideal world, is that I would say is that there should be one meeting with everyone together. But even if we start with an accountant side of it, and then it flows through and comes back.
So the entry point will be different depending on who the client is. And by that, it could be you want to invest in property, you go and speak to your mortgage broker. Your mortgage broker will say, lender won't give you any money because your financials tell me they won't give you any money. Then no doubt a client will go, no, they're just my tax accounts. I'm actually making all this money here. And it's not reflective in the information that the banks will be using to look at your serviceability. Go away and speak to an accountant. You might have the wrong accountant because they're preparing your tax
It's
in
very
potentially the wrong way.
Yeah, it's very often how you present those set of accounts as well, right? And how you present to a couple of examples is that let's say that you've got a set of accounts and the accounts are showing about 100 odd grand profit as an example. So your mortgage broker may take that 100 odd grand as a profit, right? But with the right accountant, right mortgage broker, you go deeper to it. You go things such as whether there is some extraordinary expenses that you can add back to increase the serviceability, right? Whether there is more superannuation that you paid, whether you can add back in terms of serviceability, whether there's some discretionary expenses that you paid, such as a charity and donation that you did, right? You can add back. Whether there is a one-off expenses, such as, let's say, relocation expenses that you can add back, right? So with the right accountant is that all of those is that we can add back to increase the serviceability. But it goes back to the mortgage broker again, for mortgage broker to also be receptive of this from a bank's point of view. Not necessarily all banks accept every one of those as far as out of policy process as such. So it comes back saying that, well, ideally it should be done as a team.
Yeah, so really it's irrelevant where you enter the ecosystem, but what is relevant is getting all of your advisors working on the same page.
Absolutely.
Yeah, okay. Maybe we should have called this podcast not in the balance, but we should have called it add back, because I know accountants love an add back.
That's a pretty good one as well.
Add back. Everything's an add back. Oh, add back. No, add back, add back. It's the way it is. Self-managed super fund or not to self-managed super fund? That is the question.
Yes, it is. Look, I mean, again, I'll go with what everybody says. It depends on who the individual is,
Yeah,
right?
yeah.
What stage of their life they're in. If somebody's in their 20s or they've got maybe 20, 30,000 in there, so probably not.
Don't worry about it. Yeah.
Maybe someone who's in their 40s perhaps is familiar with investing in general, because again, as trustees, you have to have full control of your investments. If they have, of course, the right mortgage broker, if they have an idea of what they want to invest in, be it sometimes it's commercial property, sometimes it's residential property. There's many ways to kind of chop and change as such. Sometimes you want to have your financial advisor on board. All depends on the balance and how old the gentleman is or the gentlewoman is, right? Because, I mean, given what stage of your life, and again, no financial advice given, you might need more liquidity versus less liquidity, right? So I would say yes, speaking from a very personal standpoint, because then you have a little bit more control of where you want to invest and what's more comfortable to you. And of course, you can take advantage of debt in order to buy properties through a self-managed super fund. So I would say yes.
And there is a balance requirement, right? Because the A6 sort of suggests that you need
That's
to have
right.
bare minimum 250 odd grand, if not more. And the second thing what we do is that we always get a statement of advice, right? So it's not coming in from an accountant.
Yeah,
to
my
say
statement of
whether
advice
you
is
do.
massive. It's,
And it's an important document. Have you
yeah.
gone through it?
Yeah, I have done actually.
You'd be surprised how many people don't. So it's
No,
an important document.
I didn't read it word for word, but I plucked out. I'm pretty good looking at documents and working out what's the
What you
important
need.
stuff. Yeah. Yeah, I looked at it. I went, that sounds pretty reasonable. But it just reminded me the significance of the compliance that you need around having a self-managed super fund. It's not like set and forget.
No, and I wouldn't advise anyone who isn't willing to actively participate in their own future, so to speak, to establish in a self-managed super. Maybe you're comfortable with it staying in an industry super fund and ticking along.
Yeah. But I think the retail industry super balances are growing rapidly, right?
They are.
They are, even though how many SMSF trustees are there now? There's 600,000 super funds, 700,000 super funds. So my numbers are outdated.
I mean, part of it could be, and correct me if I'm wrong, but it might be because the employer contribution rates are
going up, obviously,
higher as well. Part of it could be, people are just a little bit more comfortable leaving it in industry super funds.
There's a lot more people in the workforce now as well.
That's right.
So
And the other thing which I've seen feel over the years is that when finances start to become a bit harder, as it was in the last, say, 12 months, 18 months or so, self-managed super funds start to become a little bit more important, right? And a little bit more sort of, I suppose, acceptable in the sense that it's got a different funding, it's got a different financing, it's got a different serviceability maths as such. So many of our clients that we sort of see that, well, they might not be able to invest more outside, but they may have funding opportunity within the self-managed super funds. So that has bearing as well.
Yeah, I'll generalise with this comment, but I just anecdotal, I see it quite a lot. A lot of people think self-managed super funds is for the wealthy, and I think that's a bit of a misnomer. I think a lot of middle Australia are using self-managed super funds, and to the point Munzerl made, where outside of super you get to a threshold where you might not be able to access any further debt. Inside of a super fund, I see a lot of people who work in and around the public service, both federally or at a state or even a local government level. Long-term career professionals inside of these, police people, nurses, for example, a lot of them are using self-managed super fund purely for that purpose. They're capped out borrowing outside of super, but they typically have big super balances because 20, 30 years in a government job, it's a real driver, a real utility. So it's and no doubt a lot of our listeners probably are the cohort. They're the cohort also who they keep bringing up around negative gearing, right? Saying that's what most Australians... You get negative gearing, use super fund?
Would I advise it?
No, you can do, but you wouldn't advise it, no doubt.
Yeah, because, again, the tax rate's 15%.
Yeah.
And the point is, even if you look at it from a basic finance point of view, the higher the cash flows, generally speaking, the net cash flows, the higher the price of the asset, right, over time. Yeah. So you kind of want it to be slightly positive cash flow or depending on where you buy, quite significantly positive cash flow because you're paying a lower tax rate.
You don't want your contributions offsetting a negative gear property, right? Because you're not really getting ahead of it other than the capital growth, and you've got to realise it at some point in time. But
some benefits
complex
to selling before preservation age, but by and large, you want to have an asset to hold on for the long term.
Yeah, it's very restrictive, right? You can't do improvements. You can only do repairs and maintenance. And from my little understanding of self-managed super, when can it go wrong? And I know a lot of the argument for self-managed super fund is it can be generational. So a mum and a dad might be paying super into it, and their kids, when they start in the workforce, they might start tipping into the family super fund. It's all probably quite nice until kids grow up and start getting married and have kids and stuff. That's right. Can I get pretty? You can have six
members. Yeah.
6 members.
Yeah. So
6. So a member is someone who's part of the super fund. The trustee is the person who decides what goes on inside.
That's
of it.
right. That's right.
Yeah. So you can have 6 members of the super fund. Can it get pretty cumbersome and complex when relationships potentially start breaking up and people want to sort of exit and all this sort of stuff?
Yeah. Look, I mean, even the setup process of SMSF is, I'm not going to say it's a walk in the park. It's quite onerous, and it should be because it is a big decision, right? You're deciding.
But it's a fund, right? You're creating like a fund.
That's right, and you're getting full control of your future. So on that bit, yes, because to detangle that is a little bit of work as well. Quite often, what we see is the trustees might disagree with what the investment direction of the fund should be.
Does that happen?
Yeah, in my experience, it's happened several times. Yeah.
Wow. Typically not a husband and wife or
No, it's
whatever version you have of that?
typically
No.
within the larger family unit.
Yeah.
Different people have different ways of doing things, but
And
Yeah.
Abajo, sometimes it could be just the age difference, right?
That's
so
right.
you might have mum and dad, as an example, getting very close to the retirement, and you've got two kids who sort of, say, 20s and 30s.
That could be a problem. They go, no, don't liquidate the fund. We want to keep it in there
That's
because we
right.
want an
That's
inheritance. And mum and dad are going, no,
they
we want to
have
go
to.
on a cruise.
Yeah. But they also have to because there are minimum pension requirements, right? So there has to be a certain portion that is liquid, right? I see the attraction to having more members because obviously there's a larger balance, a lot more investment choices out there. But yeah, it can be pretty hairy if you have it.
Yeah, and again, this is like property investment always talks about the buying of the property.
Yes.
With self-managed super fund, most of the discussion around is that should you set it up or not, and then what do you put into it.
Yep.
But it's a whole much more than that.
Yeah, look, I mean, it's again every year you're supposed to kind of review your investments as such as well. It's a lot more in depth as it should be because you are, again, like I said, this is your pension, this is your life savings as such. So I don't think people give it the like, for example, for us, we don't just willy-nilly set it up. We, like Mansoor said, unless it hits a certain balance, we strongly discourage our clients to kind of go forward with it. Then we go to a financial planner to get that bit of statement of advice as such, and only then do we, once we think that they're the right fit, only then we suggest it or help them.
We have instances that when it went to the financial planner, right? Like all the balance is there, everything is there, and the financial planner is still sort of came back saying that we don't believe it's right for
And we
the
said no,
trustee's perspective because the education is not there, right? Or maybe that sort of that know-how or that sort of the time isn't there, right? And we accepted that. And we accept that all the time, right? So we sort of say that, yes, there are some key criteria. If they're being met, then we send that to the financial planner, but then we leave that to the financial planner at the end to make that decision. So it's a complex structure, not for everyone.
No, it is. And because of the diverse nature of the client base that you have, and I'll conclude with this question once, how do you keep things into perspective? Because you're going to have people who are buying their first investment property or setting up a self-managed super fund and the balance of that might be quite minimal to the other end of the spectrum. And no doubt you've got clients with wealth in the billions of dollars, right? You know, so how do you put it in perspective so you give the same energy and effort and gravitas to someone with $1 billion versus someone who is making their first investment on a $400,000 property wherever you can buy a $400,000 property today?
And we actually never, ever discriminate. And we never, ever discriminate because that's where we have a whole bunch of partners, right? And there's always some partner who specializes in a particular level of the client, point number one, right? And the point number two is that very often those sort of mom and dad investors who are sort of having their first or second investment properties, if I roll forward that after, say, 7 years, 8 years, 10 years with ourselves, is that we see many of those investors, they've now got a whole bunch of properties on their name. They might have few properties into their trust. They might have gone into a business and they might have established their self-managed super fund. So it's become a very large client. But if I look back to this client, say 7 years ago, 8 years ago, 10 years ago, is that this client probably was just a beginning client. And we take that and we take that experience saying that, well, that's our ideal client. And the third point is that in many, many ways, our practice is being built in terms of the referral from the existing clients, right? We don't do a lot of marketing. It's sort of, we go into the podcast, but outside is really just the existing client. And many of those individuals, I can give so many examples that is just a mom and dad individual, and they brought in some really big clients. So what we do is that we set aside the individual, we set aside the large group, we sort of say that every relationship is important. How do we do the very best on each one of the relationship? And things works out.
Yeah, what I would say from my understanding with KHI is that you're very active accounting practice rather than passive accounting practice, and I think that's an important point. And by that I mean, I'm not going to say a lot, but many accounting practices are there to serve a duty, and that is to ensure tax compliance, which is important. Whereas your practice and the KHI practice is very active, as in you work in lockstep with someone to help drive them towards the outcome that they want to work towards. You don't always get that with an accounting practice, and it probably wouldn't work for everyone. Some clients are just going, no, just leave me alone. I just just do my tax return. You go down the H&R Block and get that done, right? But it seems to work for you guys, and you can see it as it's just a common thread inside of all of your partners. I don't know any of you. I've never met any of your partners who are just sitting there with their feet up, just, you know.
No, we're being very blessed, right? I mean, this is where we say that we are a true multi-service providing practice as opposed to just being an accounting practice, right? Because if someone is just being an accounting practice, there is a whole bunch of things that you can't do it. Whereas in our case, our benefit is that as soon as we see that there are opportunities, there are needs in terms of financial planning, we bring them in front of a financial planner. Right, when we see that there is an opportunity of needs in terms of the legal service side of it, we bring them in terms of the lawyers. And the way our office is being structured, that each one of our office is that ideally we've got all of those 5 services into each office. If we look into our parameter, we've got all of those different services. So the beauty of it is that when client asks a question which is outside my legal requirement as such, I can go up there and speak to a lawyer and say that we'll give a call to this client. So that holistic level of the service is the one which makes us active, but also gets client into their goals.
You're not going to get a legal degree, are you, Munzrel? Did you get a real estate? Did you get your real estate license?
I still have a real estate license, and I had this for many years.
It's madness.
I do.
It's madness. Don't worry, Munzrel doesn't buy or sell property. Yeah, that's right. But, hey, thanks for coming in, guys. I really enjoyed the chat. Yeah,
Thank you, Phil.
Yeah, and thank you for all your help with my stuff. It's I could do it better, but anyway, we're getting there. But this is In the Balance. I hope you enjoyed that, everyone. Thanks to these guys for coming out of the shadows and have a chat. It's good. It's important, you know, helping people be a little bit more informed around this aspect, this discipline, very important discipline as investors. So you got to have a good relationship with accountants. So I'm happy to share what I'm doing with mine to help you make more informed decisions, which is good. We'll be back with more In the Balance next month. Any questions, remember, hello@khipartners.com.au. We'll answer anything within reason. It's not going to be advice. It's just going to be us musing about it. But anything you want to know around it, accounting in general, property investment, we're happy to cover it. hello@khipartners.com.au. Munzrel, Baho, Stephanie, thanks for your time.
Thank you.
Thank you very much.
Thank you.
Thanks for tuning in, everyone. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.